Hey guys. Today we will learn a little about bonds and how to calculate yield to maturity, using yield function in Excel. Before proceeding, let's understand what bond is. Bond yield, which is also known as the yield to maturity, is the interest rate a bondholder receives, if a bond is held till maturity. Bonds are debt instruments that are used to raise funds from the market and carries a specified interest rate, which is also known as the coupon rate, and have a defined maturity period. Bond markets provides a vital source of credit, which is needed for capital formation and economic growth. In the GSEC market, the government raises capital to finance its capital and revenue expenditures, whereas companies raise money using corporate bonds to fund their business expansion plans. Ever wondered how such yield to maturity is calculated? Let's look at the formula. Confusing, right? Don't worry, we won't use it here. We will just use Excel's yield function to find out the yield to maturity. Let us look at a hypothetical example to understand the yield function. Say ABC Limited Company issued a 6-year bond with 100 rupees face value on 1st August 2016 that offered 9.5% coupon rate to be paid annually. The maturity date of the bond is 1st August 2022. On 1st July 2019, the current market price of the bond in the secondary market was 92 rupees. What is the yield to maturity of the bond on 1st July 2019? Okay. Let's find out. We can find the yield to maturity of the bond with yield function in Excel. The yield function requires 7 inputs. The first is the settlement, which is the date on which the buyer wishes to buy the bond from the secondary market. In our example, it is 1st July 2019. The second input is maturity, which is 1st August 2022. The third input is rate, which is the coupon rate of the bond, which is 9.5%. The fourth input is PR, which is the current market price of the bond, 92 rupees. The fifth input is redemption, which is the face value of the bond, or 100 rupees. The sixth input is the frequency, which is the number of times the interest is paid. It takes value of 1 for annual, 2 for semi-annual and 4 for quarterly payments. The final input is the basis, which is optional and can be left blank. After putting in all values, it will generate a yield to maturity of 12.78%. The important feature that can be explained using the yield function is the relationship between the coupon rate and the bond yield. If the yield is greater than the coupon rate, the bond sells at a discount. As is visible in the example, the current market price is less than the face value. On the other hand, if the yield is less than the coupon, the bond sells at a premium. If we increase the current price of the bond to 105, the yield will be 7.61%, which is less than the coupon rate of 9.5%. The viewers can play with the numbers on an Excel sheet and see how yield to maturity gets impacted by changing the maturity date, market price and the coupon rate. Thanks for watching our video.